Absolutely delighted to have Andrew Brenton here with us today. He's the CEO and a co-founder of Turtle Creek Asset Management. Previously, he founded and was the CEO of the private equity subsidiary of the Bank of Nova Scotia, where he invested in control positions of a dozen Canadian private companies. He was head of the high technology investment banking practice of Scotia Capital in the early 1990s, and prior to that, he was a founding member and managing director in the firm's mergers and acquisitions practice. Mr. Brenton received his MBA from the Richard Ivey School of Business in 1984 and his bachelor's from Mount Allison University in 1980. Thank you for joining us today, Mr. Brenton.
Very happy to be here, Itai. I'm really I'm looking forward to this. So great. Thank you for the introduction and describing a bit of my background, my career. I think is a helpful lead into Turtle Creek and how Turtle Creek was created. So if you think of my background, also think of the background of my two founding partners, Jeff Cole and Jeff Habel. So they had a extremely similar career path. The difference is they're a little bit younger than me. So that first phase of my career of mergers and acquisitions, they just spent less time doing that. But when I set up the private equity fund or business for the Bank of Nova Scotia, so one of the big Canadian banks, the two of the key, it was a partnership of six. It was really set up separate and away from the bank, and the objective was to make money. It wasn't connected in any tied way to other parts of the bank. And of those six partners, the two of them came with me to create Turtle Creek. So we pivoted from private investing to public investing, and I think that background also informs, if you will, the investment strategy and the investment approach of Turtle Creek. We have a couple of corporate catchphrases. The one on the few slides I'll share tonight is a different kind of value investing, but another that we have is a better kind of private equity. So we really did a pivot from private equity investing to the public market for a bunch of reasons. And when we started Turtle Creek over 20 years ago, we set out six founding principles. So literally sitting at the kitchen table on a weekend, thinking, okay, what are the principles of Turtle Creek? What do we want to be? What is our philosophy in a sense? And I'll talk about those, but it's funny, even to this day, when I think we kind of dashed it all down 20 plus years ago, but when I look at them, I can't think of another one. I mean, it isn't like, oh, I wish I'd thought of this principle back 20 years ago. So think of us as at the time thinking, okay, we're going to move from private equity and successful private equity investing based in Toronto, and then we're going to focus on the public market. So if I can get this right, I'll share my screen. So you can just see the six founding principles, and those are, one, all of our money for a long time, and then a bit of a reference or a nod to Isaac Newton, where he said, "Nature abhors a vacuum." So we abhor lazy money, and I'll talk about what we mean by that. We also abhor over diversification. And then the fifth principle is the only value that matters is the present value of cash flows. So that is, absolutely core to our thinking, and of course is the foundation of value investing. And then the sixth, which is not really a principle, but an observation, is that prices fluctuate around value. And it's one of the things that just pulled us in to the public market. It's obviously something you don't have when you're investing in private companies and having control positions. So if I just now talk about the six principles, the first being all of our money. We thought if we're going to manage other people's money, we should be aligned with them, and not just somewhat aligned, but completely aligned. In other words, we don't make any investments away from Turtle Creek. Our philosophy is if it's good enough for our money, it's good enough for our clients. So that's a a really core founding principle. It's still the case that I and my two partners have 100% of our investable family wealth in Turtle Creek, and it's our intention to do that for a long time to come. And then that second part of the phrase, for a long time. It is an absolutely critical competitive advantage to genuinely take a long-term view. And I know as students, you've heard that a lot. You'll hear it a lot. It is so true, and it is actually very rare. A lot of people talk about taking a long-term view, and then you realize they're actually just trying to guess where the share prices are going in the shorter term. And maybe their definition of long-term is a couple of years from now. Our definition of long-term is beyond 5 years, and really, in some cases, much longer than 5 years. But in our view, the long-term begins around 5 years and extends out. And so, and that's such an important point as we move to the other principles, especially that last one, is that prices, market prices do fluctuate sometimes wildly away from value. But if you have a foundational quality view of value, at some point the public price gets dragged kicking and screaming toward value. Doesn't always get exactly right, but at least it gets pulled in the right direction. And if you think of our third and fourth founding principles, where we abhor lazy money, and what we mean by that is we want to be constantly trying to have an optimal portfolio. Our view is, if you feel like you own the right amount of a company today, let's imagine that in your portfolio it's a 5% weighting, and you think that's the right weighting, and then imagine that the share price rises by 20%. We had that happen to one of our companies in the last few days, where they had very strong quarterly results. The stock reacted to that, and it's continued to react to it. And if that happens, our view is, if you felt like it was the right weighting at 20% lower, and nothing's really changed. So in our view, nothing has changed to the fundamentals. They had a good quarter. The market likes it more now than it did a week ago. To sit and say, see, I was right to own this and it's up. Our view is it's now 6% of the fund. And yet it has a lower margin of safety, which of course means it has a lower long-term expected return. It's got a higher price, but our view of value hasn't changed. So the margin of safety is narrower. That's a fundamental, simple thought, but I guess it, in a sense, runs counter to the view of buy and hold. We are very much a buy and hold if prices don't change. But if relative prices change, or if we change our view on the margin of any of our companies, our view is to sit and not react to those fluctuating prices. To us, doesn't make any sense. So that's what we mean by abhorring lazy money. A lot of investors, I think, believe that their big decision is buying. I've bought a stock, I've done my work, and I'm done. Our view is it's a continuous process, constantly refreshing our view on the company based on new information. So that's step three, or principle three, abhor lazy money. And then, of course, we also hate over diversification. The idea of owning more companies that you don't know as well as the companies you own as a way to reduce risk makes no sense. The way we think about risk, we think risk is being wrong. We think risk is, having a forecast on a company, and then it turns out you were way too high, and obviously then permanently impairing your capital. Risk, of course, is not fluctuating prices in the public market. So when we started, we thought, okay, we're committing to put all of our own family's wealth in Turtle Creek. How many different holdings do you have to be fully, in effect, fully diversified? And our view is, if you own 25 quality companies, and in our case, it's 25 to 30. If you own that many companies, because we're not equal weight, we will own, sometimes as today, we'll have holdings that are more than 10% of the fund. So obviously then we'll have holdings that are well less than an average of a 4 or 3.5% weighting. But we think that if they're quality companies, if they have strong balance sheets, not fortress balance sheets, but just strong balance sheets, and they're in different industries as it happens because we're trying to find the best company in each industry, you don't need to be more diversified than that. And so from our standpoint, if someone told us, okay, you got to build a portfolio, but you have to have 80 holdings or 90 or 100 holdings, we wouldn't be able to earn the returns we've earned, because our view would be, especially when we had a smaller investment team. I mean, today we're at 11 professionals on the investment team, but obviously at the beginning there was just 3 of us. There is no way that the 3 of us could have had our arms around 100 companies or 80 companies. So that's a core principle of being concentrated in our approach. And then, you know, the number 5, the only value that matters is the present value of cash flows. That is the only thing we look at, and we're often asked, well, do you look at traded multiples of other companies? The answer is we don't ever look at that. We build up a very detailed model for each of our companies. We do the work as if we were going to buy 100% of the company, even though, of course, we're not going to own anywhere near 100% of the company, these larger public companies, but we do the work to that level. And then it is the present value of the cash flows that is the biggest driver as to what the weighting will be in the fund, that margin of safety concept again. And then the final founding principle is this idea that the wonderful thing about the public market is that prices fluctuate. And there's a great quote from John Maynard Keynes that goes roughly along the lines of, it's the fluctuating prices in the market that provide the opportunity for investors to earn great returns, but it's those very fluctuations that prevent most investors from taking advantage of it. So it's that circularity of, if you keep your head about you and you've done the work, that volatility is a fantastic enhancement to a buy and hold, and that's how we think about things. And so now, I'll just share my screen again to go to. Sorry, here we go. So then the other slide I'll just show briefly is how those principles developed into our 4-step investment process. And on this slide, it highlights in a way, the differences in each of our 4 steps. So the first step is picking the right kind of companies. So how do we find our companies? What kind of companies do we want to own? The second is that, where we spend most of our time, is that intrinsic value, building big financial models of each of our companies that we are looking at, with a way of trying to determine a balanced outlook, and therefore then have a view of the intrinsic value of the company. And then steps 3 and 4, which are really one step, but we separate them in a description because I think those steps are uncommon in the public market. So so I'll now stop sharing again so that we have the slide out of the way. And what I'll do is just briefly talk about each of the steps and highlight how I think we're different, to that phrase of a different kind of value investing. In the first step of looking for companies, we're no different than good value managers. We're looking for great operators, great capital allocators. Sure, if there's a moat around the business, that's terrific, but part of the problem with moats that are obvious, the market can see the moat and often will give the company a very, very full valuation. We're somewhat skeptical of the permanence of moats. Things change. There's technology change. There's management change. There are just so many forces in in the modern economy, that the idea that you can find a company with a moat and it's enduring, that's really tough, or that it isn't, or that you can buy it at an attractive price. So we're looking for really great companies, ideally remarkable companies like other good managers. One of the things that in a way that we're different is that we're drawn to companies that are unique. We're drawn to companies that are one of a kind. So if you think back to my comment of, we don't look at comparable companies and how they might trade. And I like it when any of our companies that we identify, you look at the public market and say, there's nothing else like this company. It's unique. There's only one of it. And when you find those companies, the prospect that they could get mispriced at times because the public market has no frame of reference. So if I use the big Canadian banks as an example, we've never looked at them. I doubt that we ever would. There are 5 or 6 very large, similar banks. The analysts cover them in great detail. They get a lot of analysis of comparison of bank to bank to bank. The idea that one of them would get wildly mispriced is it's just lower likelihood than if the companies that we own, which are unique and one of a kind. So in that first step, it's just a bonus. You never know which companies are going to get mispriced, but if you can find somewhat complicated companies where you need to do a lot of work, but where you can get your arms around the company. So in other words, we wouldn't look at a drug discovery or a biotech company, because that's very hard to get your arms around. But we like companies where there are some moving parts. But as I say, especially where you would need to do a lot of work, and you then can't use other comparables to end up with what you think it's worth. In the second step, as I mentioned, where we spend most of our time, that valuation work, I think a key difference from a lot of value managers who I listen to, they stress how conservative they are in their forecasts. And a difference for us is that we're not conservative in our forecasts. We are trying to get it right. If we think a company has a lot of growth for a long time, that will be in our forecast. If we think a company is really good at acquisitions and they have big opportunities set ahead of them, and they create value through acquisitions, we will build that into our forecast. So think of us as trying to get it right. I like to look back and say, half the time we were a little too high in our forecast, half the time we were a little too low. So I think that is a difference from many managers. Our conservatism enters on the final 2 steps, on both the portfolio construction and then step 4 that we call continuous portfolio optimization, which is really portfolio construction being refined in the face of changing share prices. So when we add a new company, and again, like a traditional good value manager, we don't change our companies that often. We have a history of adding, on average, 4 new companies a year, which of course means we're taking 4 companies out. Again, out of that 25 to 30 in a portfolio, and often, at least some of those 4 additions are re-additions, are companies that we owned at a point in the past. We removed them simply because of a more full valuation compared to other companies. But then, as inevitably happens, the share price declines, and it could be years later, and they end up at a point back in the portfolio. So we are, but when we add a company, we have a way of sizing it. And it's back to that thought of what's the margin of safety? What is the expected return from a buy and hold with the long term? And then, of course, the targeted weightings are titrated or attenuated by other judgment factors like, well, how strong is management compared to our other companies? How aligned do we really feel like we are with the board as a shareholder? How well do we know the company? How long have we known the company? So there are a lot of other factors that big driver being what's the long-term expected return. But those other factors can have an impact on our targeted weighting. But so when we add a new company, as I say, we have a means to initially size the position. So then our thinking is pretty common sense. If after we've sized it, that share price goes down, which more often than not is what happens, we know what to do. We know that if we like something for at a certain percentage of $10 and it goes down to 8, we believe we have to buy more stock to actually make it a bigger percentage in the portfolio. But equally, if the share price after we've sized it happens to go up, and at some point they all do, at a point we need to trim the position unless our view of the company's value has increased in step with the share price, which happens, of course, sometimes. So that initial sizing leads to the step 4 of once it's sized, we're continuously reacting to changing prices. And I think before we move to the Q&A, the last thing I'll do is I'll share the screen one more time, if I can do this right, to just show a case study, because I think this will help pull all those pieces together in terms of our approach. So this is a company that is based in a smaller town near Toronto called Cambridge, Ontario. It's an automation company. It's a global automation company with plants in particular in Europe and throughout North America, but also other places in the world. So think of them as a high-end engineering company that enables automating service and manufacturing processes for large corporations. It was founded by a German immigrant to Canada a very long time ago. Has a really terrific engineering culture. And that slide shows three things. It shows the black line is the share price over time, and I'll point out that the price is a log scale, a logarithmic scale. In other words, it's $2, $4, $8. So when you first look at the stock chart, you might say, well, the share price hasn't really been that volatile. But if you saw it on a linear scale, you'd see that it has been. It was as low as $3 back in 2009, and today it's around $50. And I'm talking in Canadian. It trades only on the Toronto Stock Exchange, despite the fact that most of its operations and revenue is all outside of Canada. So that is one thing on the slide. The second thing on the slide is the green line. So that is our view of value, our present value of cash flows. You can see that it has stepped up over time, but also that there was a multi-year period where it didn't go up. So, and a couple of times where we took it down. So it's back to my comment earlier. When we do evaluation, we try to get it right. If we think there's a lot of growth, which we do believe there is for this company, we'll put that into our forecast. In fact, through that period where we were essentially trimming our forecast, we were too high on our forecast. Now the company has a new, well, he's not new anymore, but the board recruited an American, I think ex-Danaher originally, so one of those terrific managers that come out of Danaher. There seem to be a lot of them. And he's been running ATS for 4 years now. And it is really, everything's come together, both on his acquisition strategy and also his organic growth. So what we saw originally, think of this as a company that in the early days when we owned it was a late stage of a turnaround. We don't like going into turnarounds when betting on somebody turning something around from scratch. And now it's in its growth phase, and I believe looking forward in a multi-year growth phase. But it's a great case study from our standpoint in terms of explaining our approach for a bunch of reasons. But the last thing on that slide that I'll point out is the gray background. So that is the weighting in our portfolio at any point in time, and you can see that there was a multi-year period where from where we start the graph where we didn't own it. There's no green line either. And the reason I start the graph in '04 is that's the first time we went down and visited the company. And at that time, we didn't understand management strategy. The founder had passed away. We spent a day with them and we came back and closed our file. But then years later, observed that there was a proxy fight, saw the appointment of a new CEO, went back down to Cambridge, Ontario, and spent a day with new management, concluded now this was the kind of company that we could really dig in on. And you can see that as we built our green line, our model, and as we learned more about the company, we were really taking our view of value of the company up in '08. And all that was happening, partly because of the credit crisis, the stock kept going lower and lower. And when we first put the company into the portfolio, the stock was around $5. And we made it probably a 4 or 5% position. And if it hadn't gone further down, that might have been it in terms of how big we made it. But in fact, it fell to as low as $3 a share over the next few months in '09. And we kept buying more shares. If it had gone below $3, we would have bought even more shares. And then you can see how ultimately it did recover. The share prices fluctuated over time. And so if you think of our process, this shows when we have the discipline not to dig in when we're not comfortable. It's our kind of company. We then, when it changed, we dug in. We had we had done the work and had the temperament, I guess, and the foundation of the work to make it at a point our biggest holding. And then today it is now again around a top 10 holding in our fund. And then if you look at the bottom below the graph, you can see that since we bought the stock, a buy and hold would have been a 22% compounded return, which, as we all know, that's fantastic. If you can own companies that will do that for you, then a buy and hold is fine. But we've improved upon that to a 30% return. And as you know from doing any kind of math, 30% isn't just 50% better than 22% compounded returns. It's a lot better because of the power of compounding. And so when you think about our activity, it adds value in the long run. We're not taking away from a buy and hold. So the foundation of find companies like ATS, where we know in the long run, or are pretty sure that a buy and hold will create you'll be a very happy shareholder, and then take advantage of market emotion and irrationalities to improve upon that long-term buy and hold. And the final point I'll make about ATS is back to my comment, the kind of company we're looking for. This is a one-of-a-kind company. Maybe the closest, some of the analysts try to use Rockwell Automation as a comp, but in any industry, every company is different. But in this particular industry, ATS is quite different than any other automation public company. So you can't look to other public companies to determine where you think it should trade. You have to do the work and develop in our view that green line that tells us what the intrinsic value is. And if you generally look at that graph, the bigger the gap between the green line and the black line, the share price, of course, the margin of safety, the larger the weighting it is in the portfolio. So I think I'll stop sharing there, and that's my formal presentation. So we can move to Q&A now.
Thank you for that presentation. It was very insightful. Two questions regarding your ATS example. The first is, how did you originally find out about the company? And the second is, let's say that the stock price had continued to keep falling, even to, let's say, $1. is there sort of a hard limit? Like, do you say, no matter what, I won't make this more than, 20, 25% of the portfolio, no matter if it keeps falling, or will you just keep adding and adding?
So the answer is, I'll answer the second part first, and then talk about how we found it. The answer is no. There is no cap. There is no cap. Does a company, when it's falling and it's already 9% of the fund, does it get a lot of attention? Of course it does. Do we constantly go back and re-ask ourselves, are we missing something? Of course. But if our thinking about the public market is, if you add a couple of thoughts together, if you first say, I only want to own honest companies. And what I mean by that is, companies that are respectful of their owners and say, look, by the way, companies that allocate some time, management time, to speak to their owners. There are some public companies that don't think that's part of their job, which I find bizarre. So it's an uninvestable company if they won't do that. So we need companies that will, we are respectful of their time, but we want to be able to interact with them. And so, but if you combine the thought of they're honest, they're not telling us stuff that they aren't telling other people. Anyone who will do the work, they're open and answer questions about the long term, which is the only thing we're focused on. We aren't focused on the next quarter. And then you get comfortable that you've done at least as much work as anyone else, and a lot more than most who are buying and selling the stock. If you put those two thoughts together, you never worry that the market knows something you don't know, right? And so, there are some industries or some companies that I will stay away from, what I would call binary companies, like a drug discovery company. It's possible the market could get wind of clinical results because somehow they find a way to get wind of those clinical results. And none of our companies have a binary outcome. There's not one piece of information that would really move the stock price. And so we never let the share price movement tell us anything. We think there's no informational content in the share price. The informational content is in the press releases and the financial filings and dialogue with management. So that's a long way of saying, no, we've never not bought more at lower prices. And I'll say, unfortunately, we rarely get the chance to make something a double-digit holding. In other words, buy more of something that's already a 10% holding. If you think back to that slide, we did not get to buy more ATS to make it more than a 10% holding. Down to $3, we made it a 9 or 10% weighting, and it got to 15 because it bounced back really quickly. And we didn't begin selling until $5. So, bought a lot all the way down to 3. And so that's the math that's how it got to be 15% by just holding off a bit before we started trimming. But by the end of 2009, and the stock had only gotten to $9 or $10. So, low was 3, but started selling at 5. By the time it was at the end of the year at close to $10, we had sold most of our shares. So it is we're happy early sellers of companies, but the symmetry is we're relentlessly more buyer of company as it gets cheaper and cheaper. And today, one holding, only one, is we think attractive enough compared to everything else that it merits being a 10.4% weighting. And we did buy more. We had the opportunity to buy more of that recently at a lower price to make it 10.6%. Again, these are incremental moves in both directions. But if that share price continued to go lower, there is no theoretical cap as to what the percentage would be. So that's answering the second part. The first part, how did we find ATS? Well, the nice thing about public companies is you can hit a button and get a list, right? And when I was in private equity, people constantly would ask, how's your deal flow? And frankly, when I started that business for the bank, and when I looked at the pros and cons of doing private equity inside a bank, there are lots of cons. And I think the big US banks experience that. And if you know the history of private equity in the US, all the big money-centered banks did have private equity operations. I don't know if any of them do now. Similarly with Canada. So there are, it may not fit inside a bank, but there's one thing a bank has. It has lots of deal flow. It has lots of flow. It may not be good, but there's a lot of flow. But it is a classic question in private equity. How do you generate your deals? What's your deal flow? If you think about the public market, the flow is right in front of you. It is a list of companies. Now, unfortunately, there is no button on Bloomberg where you can say, give me the highly intelligent, really well-run, honest, great capital allocator companies. So you need to sort through them, and it's a long process. If you think of Turtle Creek, we never looked at a US company in the first decade of our life. We had our hands full assessing the Canadian companies. So having come from mergers and acquisitions, I knew the names of all of the public companies. I just didn't know which ones we wanted to own. And sometimes when I run into the founder of a company that has long been purchased and the gentleman's retired or quasi-retired, I joke that I found him because the name of the company was Astra Technologies, AASTRA. And if you have the Survey of Industrials in Canada, just kind of leafing through, this was before computers, that would always be the first company that would come up. So years later, did go and meet with him at his head office in North Toronto, and it ended up being a holding our fund for many years, and we did really well. A great company. So it's partly just talk to everybody. We take meetings. The sell side analysts, the experienced ones, are very good at kind of sorting their companies for our criteria, because we don't care what they have a hold on, what they have a buy on today. But what we do want to understand is which companies that they cover that they think are terrific. Forget about whether they're overpriced today. And in the case of ATS, that was a long time ago, but as I say, I was always intrigued by it. Remember in my bio, there was a period where I started the high tech practice at Scotia McLeod and the investment bank. And so I was familiar with and have always been comfortable with technology companies, not kind of bleeding edge technology companies, but a company like ATS that uses technology, is cutting edge, but generates a lot of cash. And so the companies were constantly thinking about, okay, who do we want to go see? Who do we want to meet with? Who do we want to chat with? In the case of ATS, as I say, we went down and I felt guilty in that meeting because we really hadn't done a lot of work. And I remember back when I was investment banker, it used to drive me crazy when I would take a company through New York, for example, and these accounts would meet and they hadn't done any work. And I thought, when I become an investor, when I get on the other side, I'm going to do the work. And then, of course, the reality is there's just so much work to do. So I shouldn't have been critical of those groups that hadn't done anything in advance of the meeting. So that was kind of us that first time with ATS, although the CFO introduced us to the CEO later in the day as these guys have asked better questions than anybody that's ever come to visit us. So I guess we were relatively well prepared. So finding the companies, that's the easy part. Determining which ones to dig in on, that is, I think, the most critical decision that we take. And I don't want to give the impression that every single company we've ever dug in on that it turned out to be the right one to pick. For sure, that's not the case. But our batting average is pretty high. Sometimes it's absolutely obvious. In the case of ATS Automation back in 2004, after a day, to us, it was absolutely obvious we don't want to do any more work right now. In 2008, or the fall of 2007, with a new CEO and developing a new management team to look at fixing the business, or focusing back on the core would be the way to describe it. That was obvious that we at least wanted to dig in. It was a year and a half from when we went back down in 2007 to meet with new management. It was a year and a half before we ultimately invested in the company. So it's not always, doesn't always take that long, but it did in that case.
And you mentioned that there's a lot of cons for private equity firms to be part of investment banking. Can you expand on what some of those cons are?
Yeah, I mean, I think it's the conflicts. It's the I would say that the senior executives at Scotia back in the day. So Scotia was always and has been an early sponsor of the big buyout shops in the U.S., Blackstone, KKR, and each of the most senior people at Scotia had run their New York office. So I think they had been told by those groups about the risks of trying to do it inside of a bank, because the conflicts are often, when I say conflicts, I mean the pressure that you have to put capital into a company because other parts of the bank want you to do that. And to the credit of my board, my bosses at Scotia, they thought that was crazy, which in a way it is, right? Why would you're not going to buy 50% of a company just so you can earn fees on banking so I think that's the main, if conflict's maybe not the right word, it's a bad cultural fit to try to mix being an owner, and private equity is a controlling owner of businesses, when the bulk of your business and thinking in a bank is to lend money. One case you're dealing with, okay, how much should I charge? I need to get all my money back. And the other is all about the residual value in a corporate entity. It's just, it's just a bad mix from a business standpoint. And I think that is what all of the money center banks in the States also experienced. And then of course the other reality is the value of the people is such that I'm not sure that like at the end of the day they can go off and start their own thing. And it's funny, when I told the CEO of the bank that I wanted to go off, he just assumed I was, okay, you're going to go off and raise your own private equity fund. It didn't occur to him that, no, we wanted to go off and focus instead on the public market. So.
Yeah, absolutely. Let's discuss a little bit very global. Can you talk a little bit about your thesis for that? And also, are you at all concerned that rising prices of plastic will squeeze the company's margins?
Yeah, so on the margin side, it's important to know that the resin is a pass-through. So the thing you'd have to worry about is not, does it squeeze their margins? Is there a price of resin to the point where consumer demand or customer demand is impacted? And I think that's a theoretical risk at some point, but the substrate cost in comparison to other competing substrates there's a stunning difference in cost. So I don't think so. It's not a margin issue. It's a short-term margin issue, which they faced in the last couple of quarters, and it's really interesting when you listen to the conference calls with the analysts asking their questions, how focused they are on the impact of resin prices, because there's a lag. Now they've done, I think, a decent job of shortening that lag, but through a cycle, it's a nothing. And a couple of years ago, when the analysts were just spending half the call on, because they need to have their forecasts for earnings for the next quarter, where to the point where the CEO jumped in and said, guys, look, this is a nothing. Like, one year it's a headwind, the next year it's a tailwind, and you go through a cycle, and there's zero impact. So, I think in a way that's an attractive feature for us, that the market will, we think, over focus on that when, and in both directions, maybe give them too much credit when resin prices fall and it's a tailwind. So no, it's not again, I think you'd have to have, I don't know, gas prices at much higher prices than they are now before you'd ever start thinking that plastics are compromised in terms of a price in comparison with alternatives.
Yeah, absolutely. That makes a lot of sense. Thank you for sharing your commentary on that. You previously said that, well, in your presentation, you said you don't find biotech attractive, but you previously did find specialty pharmaceuticals attractive. Can you discuss that a little bit, please?
Sure. Yeah, it's funny. I think in a way, specialty pharma is, if you kind of string together a narrative about Turtle Creek, I think it's the industry where we've had the most, we've owned the most number of companies. I think it's a total of 4, and it covers off a bunch of issues with us because the first one was terrible. The first one was the last really bad investment. Now, thankfully, that was almost 20 years ago. It was, I dragged my partners into the company to invest in it. This was 2003 because I love the industry. Now, when I say specialty pharma, I think of it as the other end of the drug industry. So if you think of biotech is the drug discovery part, specialty pharma, in the way I refer to it, it is more mature legacy products, often that have been not promoted and focused on by the owners of the product. So think of a big drug company. They have lots of successful products, and they have drug reps going around talking to doctors. It's actually the first job I had out of undergrad because I had a science degree, and I recently read Empire of Pain about the Sackler family, and I highly recommend that book. Wonderful read. What a lot of that is about promoting drugs, and one could say overly promoting drugs, but I'll leave that aside. So specialty pharma, in the sense of a company that takes a smaller, almost orphan product and does a better job of promoting it, advertising it, convincing doctors, you haven't been thinking about this product, but you really should. So I love the industry because of what I just said, but the one I picked, it was terrible, and we lost money. Fortunately, I was convinced by a trader on Bay Street here in Toronto, just said, you just need to recognize you were wrong and you need to sell all of the shares because we're very incremental in our approach. And I did, and it's the last time we've ever just said, okay, we were wrong and blown the shares up. Other times we say, this company is not as good as we thought. We tend to do a gradual derating and squeeze it off the island over time. So that was the first in specialty pharma. The second company was actually, the first one was Montreal based. The second one was Montreal headquartered. And that was a really good one. They ended up being bought a few years ago by a company called Endo, which was a similar type roll up as Valiant Pharmaceuticals. And I think the person running Endo had been the number 2 at Valiant. And then in the meantime, I forgot the one in the call it the middle, a great company, Warner Chilcott, that got bought by activists, that then got bought by Allergan and was almost bought by Valiant. So that industry went from a nice, take some product and do all the things that I described, which the good Montreal company, Paladin Laboratories, was really good at, to what became whatever you want to describe that became of the Valiant, Endo, all of that craziness. So by then we were not a shareholder of anything in the industry. We tell one anecdote. So we found Warner. It was actually the first U.S. company that we owned in the portfolio. This would have been more than 10 years ago. So a couple of anecdotes. One is when we first went to see them, technically it was an Irish listed company, but the headquarters was in New Jersey. It was Irish for tax reasons. And when Warner was purchased by activists, by then, we had an intrinsic value. We really liked Warner Chilcott management. When we asked them how they think about acquisitions or licensing drugs, they looked at us and said, the only thing we think about is IRR. And I left the meeting thinking, they think about their product like acquisitions the way we think about them as a company. So there was a really good fit. But then when activists bought it, and they bought it for stock, it was already a small holding in our fund because the price was so much higher and it was close to our view of value. We did go and meet in New York with the CEO of activists, and he said, well, the Warner guys are really good. I've known them for a long time, but they just weren't doing enough deals. You know how to do more deals, right? You pay a higher price. So we sold the shares of activists that we owned at that point. And after that, I mean, I guess I watched from the sidelines as to what happened in the specialty pharmaceutical industry. So gave all that background just as a way of maybe kind of explaining how we think about things. But none of those companies had what I call a binary outcome. They were, there wasn't any one thing that would take the stock up by 50% or down by 50%.
And the first company you mentioned where your thesis didn't play out, can you discuss what happened there?
Well, I mean, what happened is I made the mistake of thinking, I like the sector, therefore let's own the company. They were saying all the right things. And I remember being in their boardroom in Montreal, having this sinking feeling in my gut saying, well, they've been saying all the right things, but they're not doing all of the right things. And so I would say that's the last time I have ever argued with my partners to go into a company because I like the sector. It's never about the sector. It's always about the company. And so that was if you will, the lesson that I took away. The big mistake was not focusing on them as a company and instead saying, I love that industry. At least back then, 20 years ago, I think it was a really attractive industry. I mean, clearly, Mike Pearson at Valiant thought it was really attractive. He really went at it. So that was a mistake, and the company, I don't think, made it. I mean, I think at a point after we were out of it, the FDA came in and gave so many citations on their manufacturing facility in Montreal that they had to temporarily close it. It just wasn't a well-run company. That was and it was interesting a few years later when we found Paladin Laboratories, run by Jonathan Goodman, the founder, CEO, fantastic management team. I asked about the other company. I said, do you remember, and he said, oh my God, yeah, they were terrible. They didn't know what, kind of said they didn't know what they were doing. They were overpaying. And I said, what did you do? And he said, we just backed away. And we have a discipline. We're not going to chase things. He would never say what the activist CEO told us, which is, they just weren't doing enough deals because they weren't paying enough. And so that was, in a way, an endorsement of this company, of Paladin, to say, hey, when markets get irrational in terms of deals, whether it's licensing in drug, licensing in the Canadian rights to something that's a European drug, or Latin America, which is some of the things that Paladin did, they have the discipline to not chase things if there's an irrational competitor, which this other group was. And he said, I didn't know it was going to hit the wall the way it did, and it happened pretty quickly. So yeah, that was the lesson. That's always about the company.
Yeah, absolutely. That's a great lesson. Thank you for sharing that with us. And you tend to focus a lot on companies that acquire other businesses at least fairly frequently. Why do you find these types of companies attractive, and how do you assess if an acquisition is value adding?
The second part,
How do you assess if an acquisition is value adding?
Yeah, no, it's a great question. So the first part of that, this is an important point. I don't prefer companies that are acquisitive. I like all companies if they're good companies, and we own companies that are pure organic growth, that are the dominant company in their industry. There's frankly just nothing to buy, and it's a bit of a green field, and it's growing, and love that. The issue in the public market is most pure organic companies, good ones, are fully valued, if not overvalued. So I'd say the market overpays, and at least these days, and who knows if it'll always be the case, overpays for organic growth and hates inorganic growth. And so what we find is that a company that is episodic in its acquisitions. So if they're a machine, there's a Canadian company called Constellation Software, and we know them pretty well from private equity days back in the 1990s. And the CEO's extraordinary. He's done an amazing job. The market, in that case, prices in future acquisitions, okay? Which he's complained about. The analysts are assuming 30 to 40 acquisitions a year because he does it on a very regular programmatic basis. But if you have companies that are episodic in their acquisitions, you never know when it's going to happen. And sometimes when it happens, they're huge, or in aggregate huge. There's a US company called SS&C Technologies, which is a fantastic company. And they have both organic growth, but they also have created a lot of value over the years with inorganic growth acquisitions. You just never know when they're going to come. Like, there was a few years ago, they spent billions of dollars on a number of acquisitions. Recently, they've done almost nothing, very, very little. Now, it's partly price driven. They are price disciplined. So I think when you have companies like that, the public market doesn't know what to do with the prospect of future acquisitions. And also, the market is quite rightly cautious about acquisitions, because there's the old saw. I don't know where it came from, but 80% of acquisitions don't create shareholder value. That's probably right. Remember, I started in mergers and acquisitions. I've seen a lot of acquisitions that destroyed value. I've seen the management and board behavior that was, in my mind, irrational. And I think maybe, for sure, partly because of that, my partners or I are pretty good at identifying the minority of companies that are good at it, are disciplined, and create value. So again, it's not that we prefer it. We just recognize that they're likely to be cheap. If you think of a lot of our companies, and SS&C Technologies is a good example, if you didn't assume another acquisition, it probably appears to be reasonably fairly priced in the market today. But they've made lots of acquisitions over the years. When we talk to them, they say, no, we're going to continue to do it. We just never know when it's going to happen. And they create so much value when they buy things, because they just have an operating model and a culture that knocks out all of that bureaucracy in the businesses that they buy. And so we've factored that into our forecast. And as a result of doing that, we say, oh, it's actually quite cheap. And in fact, we think it's cheap, and it's one of our top 10 holdings today. But we can actually toggle it. We can say, okay, what if you assume 0 acquisitions? The value goes down sometimes a lot. And so I think that would be the point. It's not that we prefer them. We just recognize that the market may not give credit for the acquisitions. And the other really important part of the question was, how do you figure out if if it's value added? So what I would say is we never assess an acquisition in the moment to try to judge if it was a good idea or not. And you asked about Berry Global. This is a company that has an extraordinary track record of acquisitions. They're in a very fragmented industry. They're the biggest in an incredibly fragmented industry. As the CFO says, we have decades of consolidation ahead of us. And then when you look at them and they show you the numbers, and again, this is why you have to get comfortable that that the company's honest. They have a slide years ago that showed, okay, the last 7 acquisitions on a post-cost synergy. So this would be with the resin buying power that they have. I'm gonna get the number right, but kind of paid 5.5 times EBITDA on average. And so that sounds pretty good. But then a few years ago, they made a very big acquisition in Europe. Took on a lot of debt to do it. I think the market, at some point, got nervous about the amount of debt. I don't think they should have. Their former owner was about to buy this company, was listed on the London Stock Exchange, and Barry came in and paid a bit higher price and got it as a strategic. I think it was a spectacular move. And people asked us at the time, what do you think of the acquisition? Like, have you done any analysis? And I said, you've got a management team that's been doing this for many years, and a company that was owned by 3 different private equity groups with a lot of that, discipline instilled in them. And you can see what they've done historically. I'm not going to second guess in the moment an acquisition. So I think it's a bit what I said to the bank back when in private equity, when we would bring a deal for approval to my board. At first, they actually thought they were supposed to say yes or no. And I said, no, you don't understand. We've done a ton of work. And before we fund, we're going to do a ton more. And so your job is to say, if you think we're crazy, then say no. But you can't, in one meeting and reading a memo, assess a yes or no on owning a company. You have to trust us. And then if you look at the results over time from what we've done, and it's not good, then you can say no, then you can fire us. And to their credit, they said, yeah, you're absolutely right. It's kind of our approach with our companies. You can look at what they've done, but then that gets subsumed into the business, right? If you think of our financial model, it also has a lot of words and a tab that would describe every single acquisition that a acquisitive company's made, how much money they spent, when it was done, and whatever we know about it. But then it's talking to the company. It's talking to, the CFO of one of our longtime holdings that's a specialty food company. It's remarkable at accretive acquisitions. He has a very high hurdle, 15% plus after-tax unlevered IRR on the acquisitions. And a few years ago, we asked him, we said, Will, let's talk about the ones that haven't worked. In the same way that you will ask and our investors will ask, well, you're talking about the good ones. Let's talk about the bad ones, like that specialty pharma company I mentioned. And there was a long pause, and he said, yeah, I think they all have met that hurdle. And I said, come on. I mean, you've made a lot of acquisitions. He said, look, they haven't always tracked in the early years to our original plan, but we always get them on model and they catch up. So is that technically right? Is every single acquisition they've made beaten their target? Probably, maybe not every single one, but most of them, and any ones that have missed haven't been terrible. So you kind of build up a confidence in a management team and a culture. You think of that comment that the Montreal specialty pharma company said, well, we just stepped back. The same thing with the specialty food company when we first got to know management, and they said, the CEO said, "Oh, you guys used to be in private equity. We compete with private equity all the time, and sometimes they're willing to pay a higher price than we are, and we're the strategic." And say, "Well, so what do you do in that situation?" He said, "Well, we just let them have it." And then you'll see times later where they're buying that company 6-7 years later from the private equity fund. So that's another way that you get comfortable that a company is good at acquisitions in a funny way when you see they haven't done anything in 3 years because prices are in this environment maybe too high. So
Yeah, absolutely. That makes a lot of sense. And for a concluding question, what qualities, background, and experiences are you looking for in students who dream of interning at Turtle Creek?
yeah, well, so obviously we like people who are really bright, and because but I would say that the quality that we're looking for is curiosity. One of my partners, Jeff Habel, it's like that's his mantra. I just want to find people who are really curious and want to figure companies out. And because while I know it's not true, I sometimes feel like I don't think I'm any better at getting my arms around a company today than when I was 25. It's like I said, probably not true. I'm sure I'm better at identifying the good ones versus the bad ones in a first meeting. But that process of just letting yourself get to know a company, it's something that I learned when I came out of school, because I came out of school probably at the height of the efficient market hypotheses, the idea that markets are perfect, the markets are efficient. And it didn't take me long in my professional life to realize that's just not true at all. And what I observed is I'd have a client and I'd get to know the company, and it wouldn't be long before we would go in to meet with the owners of the companies, like the institutions, and I'd realize I know this company way better than the portfolio manager does, who's the actual owner. So I think it's that we appreciate the complexity of the world. We understand we'll never get it perfectly right with any company because there's just too much to know. So yeah, the quality beyond just bright, keen, hardworking is that desire to just to go deeper and deeper. One of our younger members of the investment team, he made a comment in his review where he said, on this new company, I read 40 different reports, and whether that's expert network, kind of just executives and scuttlebutt and things. And I said, what are you doing? Like that? And he said, look, I'm not going to keep doing that, but I'm early in my career. I wanted to go deep down the rabbit hole on a company, knowing that so that I could learn when to dial it back, if that makes any sense. So he's clearly got the curiosity and then just and I guess a really good memory, because one of the things that we do is, and sometimes this makes companies uncomfortable, we have good memories. We take really good notes, but institutionally, I think we have a really good memory. I can tell you what the prior ATS automation CEO strategy was and when that altered a bit, and we would take him to task on it. And look, good companies actually appreciate that. We've had that feedback from a lot of our companies. So, but yeah, I'd say the one quality is that fascination and interest, the curiosity to really get under the skin of a company and find out what really makes it tick.
Excellent. Thank you so much. This was a phenomenal session, and we really appreciate you taking the time out of your busy schedule to speak with us today.
That was great. A lot of fun. Thanks so much.
Excellent. Have a great day.
Okay.